Indeed, we had a very strong half year. Our operating capital generation, which is also the main metric that we use and also our investors judge us on, was up 15%. And indeed, to your point, the non-life company was one of the big contributors next to the growth in the European business. And we used to have a 93 to 95 combined ratio. We lowered that to 91 to 93. Part of that, or a large part, is, to be honest, is also the accounting change. IFRS 17 was introduced. So part of the lowering of the guidance is also the change in accounting, but also another part is the strong underlying business trend that we see and that we also expect to continue. So far it's been a very strong half year for us.
There's a bit of nuance in there as well on the operating and capital generation, and you make this point in your statement on looking at your website now. OCG at Netherlands Life mainly falling, has had a decrease down to adverse financial markets, and I note that you're on track, as you say, for 2025 despite ongoing macroeconomic challenges. Do you just want to break down the key challenges that you find at the moment that are affecting that Netherlands Life and that could potentially affect those 2025 targets?
Right, so Netherlands Life, the primary driver of the capital generation, is also related to our investment result or in the financial markets. Now, clearly that has been more under pressure. We've seen more volatility and in the market with rising rates. So that number has been a little bit under pressure. Now, the very good news is that we have a very diversified business portfolio. And as I was saying, Europe has been contributing very positively. Our non-life business has been contributing positively, and they have been more than offsetting, let's say, some of the the impact of the financial markets on the life business. I would also argue it's a higher quality number, therefore, because the fact that this 15% growth primarily comes from underwriting result, from fee business, and there's a lower dependency on financial markets is, for a company like us, I think is good news, because we have a lot more control, obviously, over our underwriting result and our fee business than we could control the financial markets. So all in all, I think it's a strong testament that the diversification of the model works, and the 15% is I would argue, a higher quality number just because it is driven by insurance results and less by financial markets.
Yeah, just on the investment side of the business or the financial markets themselves, higher rates are good for your industry, aren't they? Because it takes away the tourists for a start, which means you can increase premiums a bit more. Plus you get better investment returns from bond assets, albeit the ones you had on the book as well have diminished in value as well. But by and large, higher interest rates are good for this industry, aren't they?
Absolutely. No, you're absolutely right. To your point, they help to on our reinvestment yield. They help in pricing of products. There's potentially over time the ability to offer more guarantees into products. So from a product point of view, from a customer point of view, higher rates is good news. And also if you look at our solvency is very strong with 201%, and that means that even if we would have some volatility in interest rates, our sensitivities to either upward or downward are very low. So that means that we can also sustain a strong solvency position. So the combination of a very robust solvency and the ability to offer new products and offer higher investment yields means indeed that higher rates is positive for us as a company.
David